All right, welcome everyone to our podcast. Today we are diving into one of the biggest accounting fraud cases in history, WorldCom. And what makes this case really interesting is not just how large the fraud was, but how simple the accounting decisions behind it actually were. Because when people think about fraud, they usually imagine something extremely complex, like hidden entities, off-balance sheet accounts, or complicated financial instruments. But in this case, it wasn't that at all.
Yeah, and that's honestly what makes this case kind of scary. The fraud didn't come from some genuine level scheme, it came from basic accounting misclassifications. That just kept building over time.
Exactly, and that's why this case is so important for us accounting and auditing students, because it shows how something that seems small, like where you record an expense, can completely change how a company looks financially.
Before we get into the fraud itself, we want to briefly introduce ourselves and explain how we'll be breaking this down.
Hi everyone, I'm Elena, and I'll be focusing on the background of WorldCom, how the company started, how it grew so quickly, and what kind of environment was created inside the company.
And I'm Maya. I'll be focusing more on the fraud itself, what exactly went wrong in the accounting, how it was carried out, and why it was able to continue for so long.
And I'm Mark. I'll be guiding the discussion and connecting everything back to the key audit concepts like internal controls, governance, and accountability. And as we go through this case, one thing we want you to think about is this. How does a company that was once one of the fastest growing businesses in the world end up collapsing into one of the largest fraud cases in history?
Because at one point, WorldCom was seen as a success story. Investors trusted it, analysis praised it, and the company was growing rapidly.
But underneath that growth, there were serious issues building, issues with leadership, oversight, and internal controls.
So, to understand how everything went wrong, we first have to go back to where it all started. WorldCom was originally founded in 1983 as Long Distance Discount Services by businessman Murray Waldron and William Rector. At the time, at a time when long distance calls were expensive and strictly controlled, LDDS offered cheaper rates and promised growth in a rapidly growing telecommunications industry.
Bernard Ebbers was named as the company's CEO in 1985. Evers was known for his humble personality and down to earth image, which helped him build trust. He was a former basketball player at Mississippi College and was also known for his generosity, such as serving meals to the homeless community. This played a key role in the structure of WorldCom's corporate culture. Under his leadership, the growth strategy was built mostly on mergers and acquisitions. Over the next decade, LDDS grew its network and absorbed many telecommunications firms. These acquisitions will eventually transform the company into a national and global powerhouse.
In 1995, they officially changed its name to WorldCom. One of the most significant milestones was a few years later, when WorldCom merged with MCI Communications, which made it the largest corporate merger in history at the time. This deal was worth $37 billion.
WorldCom operated through three divisions: MCI WorldCom, UUNet WorldCom, and WorldCom International. Wall Street viewed WorldCom as one of the fastest growing businesses in the industry during the rapid expansion of telecommunications in the 90s. Its stock price reached record highs as investors placed high confidence in the continued growth.
In 1999 to 2000, WorldCom attempted to acquire Sprint for an estimated $129 billion. The United States Department of Justice filed a suit to block the proposed merger. They argued that the acquisition would reduce competition in many of the nation's most important telecommunications markets and would result in higher prices for millions of consumers and businesses.
And at this moment, regulators were worried about WorldCom becoming too powerful. The business was viewed as dominant and financially strong.
But while the government was focused on the antitrust issues and market concentration, there was less attention being paid to what was occurring inside WorldCom's accounting system. The WorldCom collapse included accountability, fraud, and the cost of depreciation.
When talking about fraudulent activities in the corporate world, we can picture how easy it is to reduce numbers on a spreadsheet, but sometimes the numbers are so monumental that they keep feeling real.
In 2003, the Securities and Exchange Commission, SEC, filed a proposed settlement against WorldCom that required the company to pay a civil penalty of $1.51 billion, which was one of the largest penalties in SEC history at the time.
Now, can we just take a moment on that? 1.51 billion. Wow. Sometimes, when we are learning about fraud, we think about embezzlement of a couple of $100,000, but not in the billions of dollars range.
But even with the settlement being $1.51 billion, WorldCom had filed for bankruptcy, and the structured payment was not paid in full amount. But WorldCom would satisfy the judgment by paying $500 million, with their bankruptcy pending approval. The funds that WorldCom we ought to pay were designed to go directly to the victims under Section 308 of the Sarbanes-Oxley Act. This is known as the Fair Funds for Investors provision.
The SEC alleged that WorldCom misled investors as early as 1999 through the first quarter of 2002. This included overstating income through undisclosed and improper accounting practices. Eventually, the company acknowledged it had materially overstated its income by approximately $9 billion. This is not a rounding error. This was a misrepresentation of assets to divert investors to an underlying problem.
Accounting scholar Gary Goudreau notes that while Enron, who is another fraud case, used highly sophisticated financial instruments to hide their losses, while WorldCom used what he described as far more unsophisticated scheme. WorldCom was capitalizing operating expenses for billions of dollars. What Goudreau basically is saying is that WorldCom did not set up an elaborate maze. They just made mistakes, thinking they were not going to get caught.
It was taking everyday operating costs that were specifically costs paid to telecom companies and recording them as long-term assets instead of expenses. With the overstatement of long-term assets alone, this decision inflated earnings in the billions of dollars.
On November 26, 2002, the SEC obtained a judgment granting full injunctive relief. This required WorldCom to undertake extensive reviews of corporate governance and internal controls. They were not just penalized, they were ordered to rebuild their compliance framework.
Now, the company was also required to establish a training and education program for all of the officers and employees within the business. This was also implemented to try to reduce future violations of federal security laws. Now, this is very meaningful because fraud does not happen in accounting departments. It happens in cultures. It happens when oversight fails. It happens when there's a breakdown in the departments. And it happens when internal controls are weak and ignored.
Garox highlights the role of governance failure at WorldCom. He describes how the growth came through more than 70 mergers, including the $42 billion accusation of MCI. In 1998, which was a big deal, larger than WorldCom itself.
Doing the research, it was quite interesting how ignorant, very ignorant, the board's oversight was. Now, the board approved substantial loans to the CEO, Bernard Evers, and allowed incentive structures to be tied heavily to the stock performance, basically stating that there would be an incentive if the stock performance increases, which is not good. Internal auditors discovered that the operating expenses were being capitalized with the fraud, and that is unraveling.
Garox ultimately frames WorldCom as a part of a broader pattern of an early scandal that is characterized by earnings manipulation, executive greed, weak internal controls, and effective boards that had incentive structures that prompted fraud through stock price performance. The SEC did not just stop at the corporation stage, but rather the SEC went after employees as well.
And so civil actions were filed against 4 employees, which included the former controller and director of general accounting, David F. Myers. All 4 consented to court orders enjoining them from future securities law violations. 2 were barred from serving as officers or directors of any publicly traded company, and 3 agreed to be suspended from practicing before the commission as accountants.
Now, this helped us as researchers and auditors and students of auditors to dive deeper and realize that the corporate fraud is organizational, but accountability is more personal, and this stems from the culture of the organization.
When the trial began, the court did not immediately approve the proposed settlement. Instead, it reserved a decision and requested additional information, inviting written comments from interested parties before proceeding. The court would not approve a settlement before further review and conference. The case had to withstand public scrutiny. This case still matters because WorldCom's restatement expanded over time, both in dollar amounts and duration.
This shows that the level of fraud grows in layers. Fraud does not begin at $9 billion. It escalates and compounds while hiding in a complex cover-up.
The SEC explicitly noted that its investigation of fraud was continuing at the time of release.
Behind the billions of dollars that were covered up, employees were losing their jobs, investors were losing retirement savings, and the public trust was getting lost in capital markets.
The $500 million distributed to victims under the Sarbanes-Oxley Act was not just restitution, but a statement about investor protection.
So to wrap up our conversation about the fraud activity that WorldCom was involved in, WorldCom materially overstated its income by approximately $9 billion through failure to practice correct accounting.
The fraud primarily involved capitalizing their expenses instead of making them under operating costs, which is a massive misclassification.
Intuitively, WorldCom announced nearly $4 billion in irregularities. The total misstatement later grew to approximately $11 billion.
The SEC sought a $1.15 billion civil penalty, with $500 million to be distributed to victims under the Sarbanes-Oxley Fair Fund provision. The securities and litigation that followed resulted in over $6.15 billion recovered for defrauded investors.
This is one of the largest securities fraud recoveries in history.
This case established major precedent in holding executives, directors, and related parties accountable in federal securities litigation. Now, growth was fueled by more than 70 mergers, including the $42 billion in acquisition of MCI, which increased pressure to sustain earnings performance.
Weak oversight, executive compensation tied to stock performance, and internal controls failures created conditions where manipulation could continue.
The human and market impact was very heavy on the public eye and made the public have a lackluster view of public companies. The bankruptcy wiped out all shareholders. All retirement accounts were wiped out. Employee jobs were lost. And investor trust in U.S. capital markets was severely shaken.
The core lesson about this case involves that fraud does not require a very complex system of people trying to embezzle money through accounting systems and just just this complex scheme. It develops when there is just weak oversight and pressure from corporate entities. When providing fairness in the representation of financial statements, this develops trust in the public eye and, for most importantly, is investors. But there needs to be faithful representation. Financial statements represent trust, not just the numbers. Now, internal controls are very important, but oversight has a huge impact on how internal controls are effective. Regulations can enforce compliance, but they cannot enforce integrity. Now, just kind of concluding our podcast, we want to thank you for listening today about the WorldCom situation, on how they had a very weak oversight and very weak internal controls, and how they filed for bankruptcy and had to pay millions and billions of dollars. So again, thank you for listening to your podcast. My name was Mark.
I'm Elena.
And I'm Maya.